Liberation Day has come and gone, and it seems like the net impact so far has been to liberate stock indexes from some of their lofty valuations. It is an absolute bloodbath out here on Wall Street and across the broader markets. And of course, what we are going to try to unpack here is what comes next and how this develops with still more heavy-duty event risk on the calendar. This is Macro Money. I'm Ilya Spivak, head of Global Macro here on Tasty Live. And we're going to try to see if we can't make sense of how this progresses. We'll start, of course, with a look at what has occurred here, why it occurred, then see if everybody's favorite savior, Fed Chair Jerome Powell, can talk the markets out of outright pandemonium. Here's the stock market. Needless to say, it does not look great. The S&P 500 craters, and this is not unlike things we are seeing in other indexes. The NASDAQ looks very similar to this. These are both indices that are recording the lowest levels in 6 months, essentially back to September here. And if we look at the Russell, the small cap index, that's down to the lowest in a year. The flip side there, we have on the bonds a rally, as one might expect. It's concentrated at the short end. This, of course, the long end, and we can see that we're still scraping around the highs, but clearly back into a rapid advance here. And the story is, as we've described it a lot here on Macro Money, the sort of implementation of the new U.S. administration's trade policy and the effect that it's having, the chilling influence it's having on economic activity. And just to quickly catch up on the logic here, consider that the president has talked about using tariffs extensively on the campaign trail, going into the election, and of course after. So if the markets were afraid of tariffs as such, we would be seeing this pandemonium much earlier. We would be over here in November looking for it. That was clearly not the case. The pandemonium starts here, middle to late February. This is the first big sell-off. Then, of course, we get a little bit of a correction, and then the sell-off has clearly resumed and is now setting lower lows. This is very much a market that is, by definition, a trend lower, the same way this was, by definition, a trend higher. Higher highs, higher lows, lower highs, lower lows. And ostensibly, the reason that this begins where it does, the reason that stocks wait until February here to really make a move is it's not about the tariffs for tariff's sake. It's about how they're being rolled out and the uncertainty therein. And you really get a sense of what that is when you look at the GDP now forecast or nowcast from the Atlanta Fed. And it's not really the level that you're looking at here. The level is ultimately secondary. It's still quite some time before first quarter GDP numbers are published. The idea that we're looking at a 2 to 3% decline, or let's say a 1 to 3% decline somewhere in here, that's still very much open for debate. But that's hardly the point. This is a nowcast that is updated multiple times a week, usually. Anytime you get a big piece of economic data, sometimes it's updated daily if that data is coming at a faster cadence. What this tells you is the tone of that data and the extent to which the real economy is actually suffering around this uncertainty. So what you're seeing here is, of course, the woeful PMI numbers, the scary consumer confidence numbers, on and on and on and on and on. And the sum total is, it's not that the tariffs are philosophically good or philosophically bad. It's not that economic theory on them is right or it's wrong. It's not that the president is incorrect or correct in implementing them this or that way. It's that the way that the tariffs have been getting rolled out, for whatever reason you wish to construct, is having a real dampening effect on economic activity, and real economic data is telling you that the economy has significantly suffered as a consequence. Why was this Liberation Day announcement then so damaging? Well, what we got was this schedule of tariffs. And never mind what the rates are. The reality is that there are these rates bilaterally for a whole host of countries. And what this then sounds like in its inherent construction, and the market sold off overnight as soon as they heard this, is that there is a baseline tariff rate of 10%. And if the markets had it left just there, they probably would be up today, because that would imbue them with certainty. Companies would know how to adjust investing decisions, hiring decisions, supply chain arrangements. But no, what we have here are individual tariff rates that are ostensibly an opening bid on bilateral negotiations, country by country. Moreover, these rates are done by executive order, which first of all means that Congress could overturn this entire situation. And in fact, they've started doing that piecemeal. There's already action done to reverse some of the tariffs on Canada. Moreover, whoever the next executive is could just, by executive order, cancel them. And if you are a business that needs to make the plans that you need to, let's say, reshore manufacturing, because now there's a heavy tariff on Asia and not one on South America, broadly speaking. We'll notice there's a lot of preference here for South America. They only see the 10% base tariff for the most part, whereas China and Southeast Asia and Asia more broadly sees larger tariffs. So there seems to be a thread here to move manufacturing both onshore and closer, so to near shore. But if you're going to do that, that's a long-term process that takes years. Are you going to have the certainty to do that if the next executive can simply say, I don't like it, and cancel it? Well, maybe not. How long will these negotiations take bilaterally? A long time, most likely. Some months at least. Do you then have certainty with what the regime is going to be to make all those business decisions that you need to make? Probably not. And so if the problem here wasn't tariffs per se, but it was uncertainty about them, well, then the way that these reciprocal tariffs have been rolled out, and we can see this in the market reaction clearly here, it only exacerbates that uncertainty and the fog with which businesses and consumers have to operate. We see that in spades in the ISM service sector data that we see updated today. We now have both manufacturing and services. Service sector in the U.S., of course, the absolute critical engine, not just of U.S. growth, but of global growth. Really from the middle of last year, as we've talked about quite a lot here on the show, the situation in the global economy has been that the three major engines of growth, the U.S., the Eurozone, and China, have given us incredibly lopsided results, where China has been stuck in a deflationary slump since before exiting COVID restrictions, and none of their stimulus appears to be helping. The Eurozone has been in shallow recessions on and off over the past year or two. They're anemic. And the only bit in the U.S. that's been growing and growing quickly has been the service sector, largely powered by domestic demand. In fact, this is why U.S. economic strength was not spilling over to the broader world last year, because most of the demand was for services, and most of that is serviced by American firms, whereas most imports are of goods. But goods was not where the demand was. And so the U.S. service sector was really the one leg of the stool holding up, without which a global recession was almost inevitable. And what we see in this ISM data is that the U.S. service sector has ground to near standstill. At 50.8, in the logic of PMIs, you're barely growing at all. 50 is neutral. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find then here is, of course, earlier in the week we saw manufacturing contracted at a faster rate than expected, but that wasn't necessarily surprising to a terrible extent. A contraction was already in the forecast. The deviation from where the service sector was expected to be at 53 on the PMI reading is quite significant, where the difference is down to 50.8, which is only a hair above 50 and barely enough growth to avoid total stoppage. Moreover, if we look at the details of the report, we can see very troubling things indeed. New orders growth basically stalled, right down to 50. Employment shrinking rapidly. Here, we're in contraction territory at the fastest rate since the beginning of last year. Meanwhile, the price structure still very much points to rapid rise in input costs. And of course, when earlier in the week, we were taking a look at the manufacturing side of this equation. This is ostensibly where the tariffs hit the most directly because, of course, tariffs primarily are aimed at the goods side of the ledger, since, again, this is what the U.S. tends to be an importer of. If we take a look at what's going on there, of course, the cost structure is even more ominous. But here, too, new orders are outright contracting, as is employment. And so the damage to the economy is quite real, even though the tariffs are just being implemented, though, of course, the tariffs already in place already exceed those that were set up in the entirety of the first Trump administration, and that's before these reciprocal tariffs are announced. Now, from the market's perspective, it seems clear that the administration is impervious to market discipline, at least for now. The soundbite from Commerce Secretary Howard Lutnick was that the stock market sell-off is a problem for the Max 7, not a problem for MAGA. I think that sort of captures the mood in the administration. And so from the market's perspective, then, where to look for a release valve is in monetary policy. Not unlike what happened in the wake of the 2008 financial crisis, where in the U.S. you had this protracted fight over government spending, and there was really no big fiscal impulse, and so monetary policy had to go through all of these rounds of QE because that's what was the relief of last resort. And the markets are seemingly thinking that's what's going to happen here. We have, at this point, added almost a full rate cut to the overall Fed outlook. We can see, of course, most recently the Fed updated its summary of economic projections and endorsed the view they had back in December, where they're looking for 50 basis points this year from 4.4 to 3.9, and then 50 basis points next year from 3.9 to 3.4. That's a total of 100 basis points, or 1 percentage point in cuts. The markets are already north of that in terms of the cut tally. We're out to 119, so we're already out to 5 cuts, and pretty much 6 basis points shy. And as we can see, most of them are very much focused on this year, almost a full 1% in cuts already on the menu for this year, but certainly 3 of them already priced in, and then 1 with an option for more on the menu for next year. If we look at the path for this year, we can see the first cut already almost priced in for June, second one in September, third one by December, and of course, in that we are in excess of 75 basis points here, there's room for dovish surprise in all of this, which of course now points the spotlight directly on the U.S. jobs report. Expectations here are the economy added 128,000 jobs, while the unemployment rate went up to 4.2%. The markets ostensibly would be happy with weaker numbers, if only it meant that the sweet, sweet relief of rate cuts would be closer at hand. But whether it is or it isn't, we'll get an almost instant clarification, because a mere handful of hours, 3 hours after this data comes out, and whatever comes out in it, Chair Powell is due to speak on the economic outlook. It's the second month in a row now that he is there to speak directly after the jobs report, almost as if this is a press conference after a policy announcement. It is already, by the way, interesting that the Fed feels the need to comment on critical market moving data on the day of, to let the markets know how to interpret this through the Fed's lens. It sort of speaks to how tenuous the environment is. Typically, the Fed doesn't like to immediately jump into the speculative muck by commenting on the data as it's occurring, but clearly they feel the need to make themselves heard and guide the market's thinking. So we're going to get this data, and if we look at the way that U.S. economic data has been performing relative to forecasts, we can see that it's narrowly tended toward disappointment. When you're below 0 on this Citigroup Economic Surprise Index, it tells you that economic data is tending to underperform relative to consensus expectations. And that's usually because there's been some sort of turn in the economy, but analysts' models have not caught up with that turn and need to adjust. And so until we get that adjustment and this thing moves back higher, because there's been a realignment of forecasting and reality, the forecasting still runs the risk of undershooting whatever is actually occurring. And so you have this space then here for downside surprises. But whether a downside surprise on this data will really be impactful or not probably has to do with what Powell says. Now, in the wake of the last FOMC announcement on the 19th of March, Powell said, we see the consternation, we see the warning signs in survey data, or quote-unquote soft data, like ISM, like the S&P Global PMIs, like the University of Michigan Consumer Confidence data, which has cratered as inflation expectations have jumped. But from the Fed's perspective, this could be episodic sentiment and not something that's long-lasting necessarily. What the Fed wanted to see, according to Powell, was the consternation show up in hard data, and NFP, of course, is high at the top of the hard data list. And so we might get this number to disappoint, but whether the Fed takes that as a reason to feel a sense of urgency is really what is necessary here. And if Powell comes out and says, well, yes, there's a lot of consternation in the markets, but we don't want to get it wrong. We see the economy slowing as a consequence of this, or at least taking a hit, and we had this in our forecasts. You can see that the Fed downgraded expectations for growth in March, but they also increased their expectations for inflation, anticipating that adding an additional tax on imported goods will just make the price of those goods higher. At least that's been the historical example, and certainly the Fed isn't wrong to cite it. We see the same thing in the ISMs. The price growth component is not falling off in services, and it's running away to the upside in manufacturing for obvious reasons. And so if the Fed then decides, in Powell's telling, to sit on its hands and let the balance of risks work its way out to where it's unmistakable that they can put inflation in the back of their mind and fight the growth and employment fight, that if the Fed is still inclined to wait and see how things shake out, well, then the market doesn't get its white knight. And if that is how this ultimately goes, then seems to be a lot more selling of stocks to be done and a lot more future easing to price into the long end of the curve, as the market reckons the Fed is going to have to play catch up, and quickly, if it delays for much longer. That is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow, as I am every Friday. I'm also there on Mondays, on with Victor Jones for The Price of Truth on Tuesdays, also on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for watching. If you're doing so on YouTube, like and subscribe. Good luck out there. Macro Money's back next week.